This is Duke University.
Today we're going to talk about race discrimination in higher education bond markets. Race discrimination is an ongoing hot-button issue in our society, and usually when we hear the term race discrimination, we think about one race, whites, treating a different race, blacks, in an inappropriate manner or in a way that suppresses or makes one race inferior to another. We commonly think about this in labor markets. You hear a lot of stories about how a white employer has a preference to not hire a black worker, maybe not hire them, maybe pay them less. In economics, we would call that taste-based discrimination, where you hire someone based on your personal preferences for whether you want to be around them. That's what we think about when we say the word race discrimination. But in real life, when you start pushing and you say, are you really discriminating against this individual? Someone would say, no, I'm not a racist. It's not that I don't like the color of their skin. It's that the color of their skin tells me something about them. So back to the labor example. The white employer might say, no, it's not because they're black per se. It's because on average, blacks come from poorer neighborhoods, which means they may not have health insurance, which means they may miss work more. And so that's the reason that I don't want to employ them, not because they're black per se. In economics, we have a name for that. That's called statistical discrimination, where the color of your skin actually tells you something statistically or on average about someone. When you're studying race discrimination, distinguishing between those two issues is critically important, and it's very difficult to do in many settings. We're going to try to crack the code on this or try to make some progress in understanding race discrimination by looking at the higher education bond market. So there's two pieces there, higher education and bond market. So why would we focus on higher education, colleges and universities? The reason for that is we can delineate them into, in some sense, black schools and white schools. So the Higher Education Act of 1965 designates certain schools as what we call historically black colleges and universities. And obviously, if you get that designation, we can clearly and objectively delineate schools between black and white. Another novelty or another reason that it's important, this is a novel setting, is because that same Higher Education Act of 1965 acknowledged that in historical terms, the federal and state government had discriminated against these very schools in terms of funding. And so we have a nice historical setting where discrimination has been found to exist. And what we're going to do is see if the discrimination translates over into the municipal bond market. So you might say, well, why bond market? Why are you doing that? Well, it turns out that bond market investors tend to be wealthy individuals. And the wealth distribution in the United States is well known to be tilted in favor of whites. What that implies is we're setting up a design or a test that essentially does the following. If I have a white investor who's going to invest in some bonds, some coming from a white school, some coming from a black school, which one would the individual be more likely to invest in? That notion is what we're going to study in this paper to figure out whether investors have a preference, if you will, for a certain type of school's bonds. It's going to turn out the bond market is going to be very, very advantageous for us to rule out statistical discrimination for reasons that you'll see in a moment. So in order to assess race discrimination in a bond market, what we have to do first is have a quick primer on how bonds work. So imagine a school wants to build a dorm. Let's suppose that they're going to issue a $30 million bond to build this dorm. So think of a bond as a piece of paper that just entitles the holder of that piece of paper to a stream of cash payments. So for example, if the $30 million bond pays a 5% annual coupon and it has a maturity of 20 years, what that means is that piece of paper in your hand entitles you to $1.5 million payment 20 times once a year for 20 years. In real life, one person probably won't go buy that entire $30 million bond. Many individuals will buy pieces of that $30 million. And finding those individual investors to hold that investment is not so easy for schools. So they want to build a dorm. They're not really good at finding investors to buy their bonds. In comes the underwriter to fix that problem. So there's a service that underwriters provide, like big investment banks. They will come in and buy the entire $30 million block from the school. And they say, don't worry, I'll go find buyers. I'll buy the whole block from you and I will turn around and sell it to buyers. I'll find them on my own. And all you have to do is pay me a fee. So the schools will essentially pay the underwriter to go find individual investors. So the schools don't have to worry about it. That cost, the amount that the underwriter charges the school, is called a gross spread. So our story in this paper, what we're going to investigate is whether gross spreads in some sense are higher for HBCUs than non-HBCUs. And the idea here is as follows. If it's harder to find a buyer because the average buyer is a wealthy white individual, you might have to search much harder to find a willing buyer for an HBCU relative to a non-HBCU. If that's true, the underwriter has to work harder and in turn charge the HBCU more to place the bonds in the hands of investors. So I know what you're thinking. You're thinking, this is not race discrimination. It's probably statistical discrimination. Why do you say that? HBCUs are well known to be of poorer financial health than non-HBCUs. And so you're saying it's not that investors don't like HBCUs because they're black. It's because the HBCUs are less likely to make the payments on the bond. And that has nothing to do with racism. That would be an argument about statistical discrimination. And I agree, that's a potential problem. It may well be that people just don't want to hold bonds that aren't going to pay them back. And it will be much harder to find such a buyer. There's two novelties in the bond market that's going to help rule this out for us. Those are credit ratings. So credit rating agencies will come in and rate the bonds, and they will say, here's your credit rating. So if you're AAA rated, that means that the likelihood that you're not going to pay the bond back, make the bond payments on time and in full, is very, very low. Well, schools have these bond ratings. And so we could compare two schools, for example, that have AAA bond ratings. So it's very unlikely that the ability to not pay you back as an investor is due to the type of school, because we can actually see a measure that tells us whether you're likely to pay back or not. The other novelty is called bond insurance. And so some schools say, I know you're worried about the fact that I might not pay you back. So they'll go pay an insurance company that will make the bond payment in the event that the school cannot. And so these two notions about not getting paid back, while plausible on the surface, are ruled out, or we're able to rule them out quite forcefully in our research setting by exploiting the municipal bond market. So let me give you an example of what our paper is all about in terms of making an inference. So let's just compare two schools. Alabama State, that's an HBCU founded in 1867 in Montgomery, Alabama. And let's take another university, the University of North Alabama. That's a non-HBCU founded in 1830 in Florence, Alabama. So we have two schools that are in the same state. They're both public schools, about the same size enrollments. And what we're going to do here is essentially compare a bond that comes from Alabama State and a bond that comes from North Alabama. They'll have similar size bond issuances, similar credit ratings, similar insurance companies insuring the bond payments. And so we can pretty much rule out all these other effects related to the ability to pay. And our prediction, of course, here would be gross spread for Alabama State will be higher than the University of North Alabama. If we find a difference, it's hard to say it's due to statistical discrimination pertaining to the inability of one school to pay over another. So here are our results for our paper overall. We get a 23-year sample period, 1988 to 2010. It's about $150 billion worth of bonds that were issued by colleges and universities. What we find is, on average, that HBCUs pay about 20% higher gross spreads than non-HBCUs. In terms of basis points, that's about 17 basis points. So you might say, well, is this really plausibly race discrimination? I agree with you. You've probably ruled out the fact that there's differences in credit risk or the ability of one school to pay better than another school. But there are still reasons to be cautious. The municipal bond market is $3.7 trillion. That's how big it is. There are a lot of buyers, a lot of active individuals participating in this market. Typically, we think in economics that large markets will remove the effects of race discrimination, because if you can't find one buyer, there's another one waiting in line who is willing to transact in the marketplace. The other issue is that in the bond market, unlike the labor market, where an employer is worrying about interacting with a black individual, where they just don't even want to be around them from a race discrimination standpoint, there is no real interaction between the investor and the school. It's just bond payments showing up. There's nothing more to it. And so you might be cautious to suggest that our results so far are purely due to race discrimination. We've ruled out other things. It's unclear what would be left other than race discrimination, but perhaps we can do better. So here's what we do to rule in race discrimination. When we talk to bond traders about this issue, what they say is it's hard to find a buyer for HBCUs because of state tax benefits. And what that means is a municipal bond carries with it a state tax exemption, meaning that if you live in the state of Alabama and you buy a municipal bond from either Alabama State or North Alabama, you will get a tax exemption. It's beneficial for you to buy bonds from the same state in which you reside. You wouldn't get a tax benefit from, for example, buying a Duke University bond or University of North Carolina bond if you live in Alabama. So what happens is schools are what we call geographically captive. It means the marketplace for them is limited by their state boundaries. The individuals who really want to buy the bond are going to be in the same state. It doesn't mean that outsiders can't buy those bonds, but they're just not incentivized to based on state tax benefits. It turns out that's a great feature for us in terms of trying to rule in race discrimination. This is because we can score individual states based on racial animus. So there are scores out there, for example, what was the white vote share for Barack Obama in 2008 versus John Kerry in 2004? We can also look at the number of racist tweets that happened in each state when Barack Obama was elected. We can look at a state's opposition to affirmative action, et cetera, et cetera. There are many metrics you can use. And what we do is we score all the states across many metrics, and then we sort them, and we figure out which are the most racist. And so what we find is in the far deep South, the most racist states turn out to be Alabama, Mississippi, and Louisiana. So what we conjecture is that if our results are really due to racism, then the effect should be much stronger in these high racism areas than in non-high racism areas. So here's the example, going back to our schools in Alabama, Alabama State and North Alabama. What we found before is overall on average that there was about 17 basis points more that had to be paid by HBCUs relative to non-HBCUs. Our prediction would be that this would be much stronger in high racism states and much lower in low racism states. So let's add in two new universities. So instead of just considering Alabama State and North Alabama, who are in the far deep South, let's also consider American University and Howard University in Washington, D.C. Howard University is an HBCU, American is not. What we would predict is that if this is due to race discrimination, the difference between schools, HBCU versus non-HBCU, should be much, much larger in the far deep South than it is, for example, in Washington, D.C. That's precisely what we find. So when you're doing the comparison of American and Howard University in D.C., the difference between them is only 11 basis points. But when you go down to the deep South and you focus only on schools like Alabama State versus North Alabama, what you find is a difference of 29 basis points. So it's about 3 times larger when you get to the Deep South. It's hard to explain that result with anything else other than race discrimination. And so that is an important finding in our paper that helps us rule in that what we're documenting is due to racial animus in the municipal bond market. So you might say, okay, that's great. How do we fix this? Well, the reason that this occurs is because of this geographic captivity. If we could somehow expand the market of individuals who would be willing to buy the bond, then we perhaps could break the setting or the race discrimination that's inflicted on HBCUs. One way to do that is to make the bonds triple tax exempt. Now what that means is it's exempt from tax at all levels, including the state level. If you designated HBCU bonds as triple tax exempt, then anyone in the United States would get the tax exemption at the state level, not just the investors in the same state. That would break the captivity. So we forwarded this as a possible solution to this problem, and it was picked up and written into a bill, H.R. 6048, titled the HBCU Investment Expansion Act. And that was introduced to the House of Representatives back in September of 2016. That same bill was referenced recently in late February of 2017 by the Congressional Black Caucus in their letter to the Trump administration, suggesting that they get behind this bill as one of the many ways to help HBCUs as they try to finance their needs as educational institutions. So to conclude, what we've learned today is race discrimination obviously remains an important issue in our society. It can even exist in large capital markets, such as the municipal bond market. Separating race discrimination from statistical discrimination is quite difficult. And if you're going to make progress on solving race discrimination issues, you have to be very careful to make sure you can rule out statistical discrimination.